Creme Wealth Management, we come with no pretense. Financial advising, making money make sense.
Hello, and thank you for taking the time to join me today. I wanted to go through this presentation on how to navigate bear markets, especially in light of the COVID-19 crisis. So today we're going to talk about 5 words that we hear a lot in the field, which is this time it is different. And it's true that there's some pieces of COVID-19 that is different than other illnesses of the past. Some are similar. We're going to look at some of those. But the point here that we're going to make is, even though this time is different and this virus is a little bit different in the market, the end game doesn't need to be different. So we're going to also look at that. So our country has survived past pandemics. There's been quite a few. The 3 that we have listed here is polio, which was the late 1940s into the 50s, where it peaked. In 1952, the casualties from polio in the U.S. were 57,000 cases, 3145 deaths, and a little over 22,000 disabilities from it. H2N2 is another one that comes up. East Asia virus was 1957 to 1959. Death count from that's a lot more. We're looking at 1.1 million worldwide that happened during that, at 116,000 in the US, which is probably the closest comparison that we really have to look and say, from a market perspective, what happened when there were that many deaths in this country. Swine flu was another one that we wanted to put here. In 2009 was the first US national emergency, well, not the first, but one of the more recent US national emergencies. 22,000 cases, 4,000 deaths. There were also some other ones, Ebola, H1N1, quite a few others. So we've been through this before. So we want to look at how the markets responded during these times. Plus we'll look at some other crises that weren't just pandemics as well. So we're looking at polio to today, basically. So January 1949, it started to peak those last few years through the last end quarter of 2020, March 31st. What we looked at is to see what was the CPI, what was the Consumer Price Index. This is where we grade and rate inflation to say, how much is your buying power? Well, in 1949, it was 24. And March 31st, 2020, it was 259, which we see was a growth of 11 times over that. The S&P 500, on the other hand, which is the 500 largest US companies, was 15 back in 1949. And now it's 2585 as of the end of March. And that was up 168 times. So growth is annualized at 7.3% plus dividends on top of that. So if we put dividends on top, we'd be closer to 10% over that time frame. So you just see how much better the stock market is to keeping up with inflation. The Great Depression, 1929 to 1933. The cause of the Great Depression was inflated stock and real estate prices. We had excessive leverage going on and margins on assets. There were no bank guarantees on deposit, no Fed or congressional intervention to stimulate the economy. And the result during that time was a GDP decline of 26.7%. So the overall output of the whole country was down by 26%. Unemployment was over 20%. And deflation, so we didn't have inflation during this time, we had deflation. It was actually at 30%. There was overall pessimism and just loss of confidence during that time. Now let's fast forward 2007, 8, and 9. We hit the Great Recession. So the cause of the Great Recession was financial deregulation. There was a massively inflated real estate bubble. There was some subprime mortgages, shadow banking going on, excessive leverage and derivative trading, and a systematic breach in accountability and accounting. So the result of that was the GDP decline at that time was 5.1%. Unemployment was 10% with no deflation. So when you compare those, you can see that the Great Recession was quite a bit worse than the Great Depression when it comes to the numbers. And we wonder why. Well, predominantly it's two things: monetary policies and fiscal policies. So monetary policies, when we talk about that, we're talking about the Federal Reserve predominantly, and they control interest rates and provide liquidity to the markets. So what happened? The Fed dropped the interest rates then, just like they're doing now. So interest rate drops and liquidity increases. There's more money in the market. Fiscal policies, government spending. This is the legislation side. Government spending increased, which stimulates the economy, and taxes decreased during that time, which also stimulates. Again, not that dissimilar than what we're seeing today in the policies that are coming out with the CARES Act. So the bear markets of 1930s and 70s and 2000s we're going to take a look at here. So before we do, we want to compare these and compare different portfolios during these time periods. So the first thing to look at here is when we talk about an asset allocation portfolio, the definition of an asset allocation is just saying how much are we going to put into stocks and stock-based index funds, ETFs, mutual funds, and how much into bonds or something more liquid such as US Treasury bills. So in these examples, there's 5 general asset allocated plans. They're represented by the S&P 500 for stocks. The bonds are represented by US government long-term bonds, and income is US Treasury bills. So when we look here at the different ranges, we'll see these 5 different options. Aggressive growth, these are going to be people that have a little bit longer time horizon. So typically 20 years out from retirement at least, you're going to be aggressively positioned 100% in stocks. More often than not, if you're within 20 years of retirement, you're going to be in one of the other options of growth all the way down to income if you're more in retirement in a later stage of retirement as well. So it just shows how stocks decrease in those portfolios and fixed income increases to put more stability in over time. So when we look at the Great Depression in the light of those different portfolios, 1930s, there were fears going on. There was depression. There was 25% maximum unemployment. They were afraid about a double recession dip that was, said to potentially happen. And the war in Europe, they were worried about that again. So there was deflation. And what was going on in the numbers was during that 10 years, 1930 through the end of 39, S&P 500, Standard & Poor's, was down 0.06% during that time frame. Bonds were up 4.88%, and Treasury bills were at 0.55. The short-term interest rates were fairly low at 1.5%. The inflation rate was not an inflation rate, it was a deflation rate because it was negative 2%. And the unemployment rate was at 18.23% average. Even during that, we'll look at these 5 portfolios and say, well, if someone invested $1,000 at the beginning of 1930 and let that $1,000 ride in one of these portfolios, we see that aggressive growth, that means 100% in the S&P 500, is the only portfolio that lost money during that 10-year period of the Great Depression. That's shown in the red. The blue is the income-based one that has 20% in Treasury bills and also a lot in bonds, with only 20% being in stocks. So that had the most return. So that was up 46% over that 10-year period. And then everything in between also gained money, somewhere between 19% and 38%, depending on your bonds and Treasury bill mix in there. The energy crisis. So we didn't have a pandemic, but we did have a lot of crises going on in the country. We had wars, and we'll look at here. So we had wage price freezes. There was Watergate, and Nixon resigned during that time. The oil embargo with OPEC and the oil crisis. Escalation of the Vietnam War. New York City was near bankruptcy. 3 Mile Island disaster happened, and there was hyperinflation. During this time, the S&P 500 returned 5.86% annual rate of return, which is pretty good. Government bonds were at 5.51%, which is very good. Treasury bills at 6.31. That'd be amazing to have right now. But with that came short-term interest rates of 8%, and the inflation was a little over 7%, and unemployment rate was at 6%. So there were fairly good rates of returns, but very high inflation as well. So what we see in that 10-year time horizon is, again, $1,000 invested beginning of 1970. If you just let that ride in a portfolio to the end, you didn't do anything, you didn't react to the markets going down, as we can see happened in 74, a conservative growth portfolio would have grown by 82%. In fact, every portfolio would have been up somewhere between 76% and 82%, depending on your positioning. So the 2000s provided a lot of challenges as well. We had the dot-com bubble right at the start of the 2000s. We had the September 11th terrorist attacks. Then there was the Iraq War in 2003. We had companies dissolving. Enron, WorldCom, Arthur Andersen, Countrywide, Lehman Brothers, all gone. 2008 housing bubble happened right after that as well. And then the government stepped up and said we need to put some reins on the financial system, and they put the Dodd-Frank Wall Street Reform and Consumer Protection Act in place. And that's what's actually helping us to weather the storm that we're going through today a little bit too. So in the 2000s, we look at the numbers, 2000 to 2010 basically. Again, this is the second decade, the only other decade where there was a negative return in the S&P 500, just like in the Great Depression. This one had a 0.95 negative return in the S&P 500 annually. There was the U.S. government bonds, however, were getting 7.69%, which is pretty good. Treasury bill, 2.76. Short-term interest rates were at 5.96%, and inflation was a very moderate 2.52%. Unemployment was at, overall on the average, was 5.54%, but obviously we talked about how it peaked higher than that in 08, 09. So again, if we look at these portfolios and say, if someone put $1,000 in at the beginning of 2000, now they just ran through a buzzsaw in the dot-com bubble burst that happened, and then the housing crisis. So they basically had two market pullbacks. And what we see here is in every portfolio except an aggressive growth, all 100% in stock portfolio, there was still gains with both of these back to back. So in these situations, the aggressive growth was down about $100, and then everything else was up somewhere between 17% and 73% over that time frame, depending on how you were positioned. So it sounds like what I'm saying is you should never be in aggressive growth, which is not the point at all. It's just that we need to integrate some fixed income, potentially treasury bills or something that's a little bit more liquid to weather the ups and downs of the storm. Because what we see here on this scale, so this is looking over 90 years of the market and saying if you put $1,000 in 1930, what would that be worth now? Well, you see that top line is aggressive growth. That's 100% the S&P 500. That is the highest. So that's 4.5 million. And this is a logarithmic scale, so it's not exactly to scale when it looks when you look at the differences in distance. So we have 4.5 million, and then growth being 3.1 million, moderate growth, which is about a 60% in the market, 40% in fixed income at 1.8 million. But if you were all in income that whole time, you were only at 260,000. So it really is important that your portfolio fit you in your goals, and you take the amount of risk that's appropriate and that you can handle to weather the ups and downs. So again, looking at just a little bit more of these numbers, aggressive growth during that same 90 years, 4.5 million, it is an annual rate of return on average of 9.8%. The growth portfolios, 9.4%, moderate growth, 8.7%, conservative, 7.4%, and income, 6.4%. So you see that just a few percentage points compounded over 90 years does make a difference overall with the account value. So key takeaway number one is that a broadly diversified portfolio of quality stocks and bonds helps to mitigate risk over the long run. And the other thing we have to take into consideration is understanding investor emotions during this time, because there are portfolios, as we go through financial plans together, we're going to say, well, the computer says, the algorithm says you should take this amount of risk, but if you can't emotionally handle that, then you shouldn't take that amount of risk. You should take something maybe a little bit closer to what you're comfortable with. So if we look at the emotional roller coaster, this is typically what it looks like, you know, starting with optimism, going to excitement, thrill, euphoria, right before the dot-com bubble. It's the time that I think of where there was maximum euphoria and people were very happy, or right before the housing bubble when everyone was buying 2 or 3 houses as rental properties. That's the time where there's the most amount of risk. And that's where things can sometimes start to go wrong. So things go down from there very quickly until you hit that bottom point where you're at depression. I tell you that I think that most of the country is getting pretty close to there right now, just with this being sheltered in place, not having your social structure, your community around you to help support you. So the good thing is that, well, at this stage, this is actually the point of greatest financial opportunity. As we saw the markets a few weeks back appear to have bottomed out, they might go back down too, we don't know. But that was that perfect time to make a change, to invest a little bit more, to help get out of this rut a little bit faster. So how do we measure investor return? Well, it's one part investor behavior, and that's both the behavior of the investor and the advisor in their world, helping them to understand the big picture and to stay the course or do what's right. And then also the performance of the investment. We have to be in good stuff. We can't hold on to bad funds and just abdicate that responsibility. We have to make sure we're in the right things. So this is kind of interesting because it shows the economic sentiment of the U.S. economy. So Americans through 2008, 2009, 2010, in the red, you'll see all those years did not think very favorably about the U.S. economy, saying that it wasn't a good economy. In 09, 10, 11, 12, that whole time up until 2017, they said it was more bad than good, or more people thought it was bad than good. And not until the last 3 years that there seems to have been a flip in that perception. But as those 2010, 11, 12, 13 years where people thought it was more bad than good, what was going on? Well, if we look at what was going on, well, it was booming during this time. In fact, we just went through the greatest bull run in history. So the blue line shows in the background the S&P 500, how it dipped in 09, unemployment rate hits 10.2, and then it starts coming back up. And the red line is showing domestic equity mutual fund flows. So what does that mean? Well, it means that people were taking money out of the market at that time. So during those years, money was going out and it was going into bonds over that time. So it was going out of stock-based mutual funds or ETFs and into bonds, which is fine if that's your plan and you need that fixed income for your retirement plan, great. But if you're doing it out of the emotions and out of fear, well, if we look here, the S&P 500 in 2009, the last 8 months or so of 2009, returned, oh, I'm sorry, the 10-year run was a 482% return on the market. In 2009 alone, the S&P was up 31%. where the bonds that more people were fleeing to were up probably somewhere between 8 and 10% during that time. So this is just showing that the flows were leaving from the equity mutual funds and entering bond mutual funds. As we see, the numbers are almost identical. So there's the numbers there. So 2009, 31% is what the market was up, where the taxable bond funds returned 8.7. So they were fleeing at the wrong time in 2009, thinking that the market crash was coming, and they were a little bit too soon. And without this pandemic happening, who knows how 2020 would have returned as well. So Warren Buffett talks about how money is like soap. The more you handle it, the less you have. So we try to put people in the right portfolios. We believe in getting in the right stuff and mostly staying put. You know, there's some tactical things that can happen, some rebalancing. We'll talk about those things a little bit later on, but for the most part, you just want to not be emotional when it comes to your money and your investing, and be in the right things from the get-go. And just like that, key takeaway number 2, it is very easy to get emotional with your money, especially when we're looking at all these dramatic headlines. And we'll look at the headlines a little bit more on a different slide, but just think about, you know, dialing it back, not following some of the news stories. The news is incentivized to get people to click on their links to get paid by those sponsors. So just take it with a grain of salt in some ways, because a lot of what's going on has already been priced into the markets, as we're even seeing today, as they're announcing more unemployment numbers coming out, and the markets have gone up because those unemployment numbers were better than what was already projected. So the question that we get asked a lot is, well, how long can this be? How long can stocks be down when we enter a bear market like we just did? So the short answer is it depends on what bear market we're talking about. If we look at the Great Depression, so the market bottomed in June 1st of 1932. If you did nothing at that point, it would have recovered in 4 years and 4 months. If you had bought more during that time when it was down, you would have recovered a lot faster in 3 months. If you had sold out and just said, "No, I'm out of here," you would have had a 78% loss that you would have realized. And if you had just waited, you would have received a 1-year recovery from the bottom of 137% increase. It's a pretty large jump in 1 year. We look at the oil crisis of 72 to 76. It bottomed out October 3rd of 1974. If you did nothing, you would have recovered in 1 year in 8 months. If you bought more when it was down, you would have recovered in 5 months. And if you sold out, you would have realized the 44% loss. And the 1 year recovery from the bottom of this was a 44% gain. We look at a few other examples. We've got the internet bubble of 2000. That was 3 years and 6 months to have a full recovery after that. And 08-09 financial crisis was 4 years and 1 month was the recovery time. But the interesting thing here is that's 100% recovered. What we see is that the 75% recovered, if we look at the internet bubble, for example, that happened in just 7 months. So it came back fairly quickly. And then the last 25% took almost 3 years to fully get back. So when we look at all these biggest decline days, we have Black Monday, 33% down between August and December of 87. We have the Gulf War, 1990, down 19%. Asian monetary crisis, down 19%, 98. Tech bubble in 2000, down 49%. Financial crisis, down 56%. Credit downgrade when the U.S. Credit was downgraded in 2011, 19% down. And even the trade war, when a lot of people thought we were going to be entering World War III with China, 19% down in the markets. But what we see is the next 12 months, all those green numbers show there was a lot of upside that happened after those downside took place as well, to the point where the Gulf War, you more than recovered in the next 12 months what you lost. And the same with the Asian monetary crisis, and the same with the US credit downgrade and trade war. And some of those took a little bit longer. But over the last 20 years, if we look in that black box, 24 of the 25 worst trading days were within just 1 month of the 25 best trading days. So typically what we see even in March, right? We had one day where it was 10% down, the next day it was 11% up. That's very common, where there's going to be downs and then it's going to spring back up, almost like you're holding a beach ball underneath the sea. Once you let go, it's going to pop up. So as I mentioned before, here's the slide on headline risk. So we have in 2009, this is specifically looking at the Great Recession. Job losses hint at vast remaking of economy. New York Times in March 6th of 2009. 663,000 jobs lost in March, tops. 5 million unemployed. New York Times again, April 3rd. George Soros says U.S. banks basically insolvent. Reuters, April 6th. Chrysler filed bankruptcy, according to CNN Money, May 1st, 2009, and General Motors Market Watch reported June 1st, 2009, filing bankruptcy. And the Huffington Post saying global economic shock worse than the Great Depression. That was a very scary time, but what's really interesting is we look at these dates and say, okay, March 6th through June 1st of 2009, which is where we took these headlines from. Well, what happened in the markets? If we look at the markets, they were up during this 3-month time horizon by 35% over 3 months. And we had already bottomed out. So it's very easy to look at the headlines and worry and say, well, jobs reports are coming out. What's that going to do? But they may not have any implication to the markets, and the markets are going to do what they're going to do, which is to improve, optimize, and continue to move forward in a way that produces as much revenue for shareholders. So key takeaway number 3, historically, it does not take that long to recover from a bear market. The most significant gains tend to arise after the deepest declines, as we saw all those dates where it went down so much, but also came back quite a bit in the following 12 months. So how do we survive a bear market? So the first thing is, like I mentioned before, we want to be in quality investments. We want to be broadly diversified. We want to have world-class asset managers and just advisors in your corner speaking truth and wisdom into your situation. And be patient. We can definitely help structure things in a way that helps you to be patient and understand that this is a long game, but there's a certain amount where you have to also come to the table and know, okay, I have 3 years of cash on hand, it's going to be okay. Or I'm not retiring in for 10 years, it's going to be okay. And we're going to help you with that. So a strategy that we never recommend is to move some or all of your stocks out of the market until the dust settles. There's some advisors that are out there that talk about buy and sell and stay out of the market strategies. We just don't agree with that at all. And the main reason why is, as you saw, there are times where the market goes down, but they also come up, and we don't know when it's going to go down. So more often than not, those people are going to sell after the market's already down, and then they're going to miss the market coming back up before they get back in. We're emotional. We don't have the answer. So the best thing is just to be in the right stuff, positioned the right way, so you can just weather the ups and downs no matter what. Key takeaway number 4, if you feel something must be done in order to be more confident, please call and discuss it with us. Discuss strategies that make sense in your situation. We want you to feel confident, and that is important. So just don't do knee-jerk reactions. Always make sure you have someone that you can bounce the ideas off that's in this and understands what's going on. Key takeaway number 5 is, when markets are a lemon, let's make lemonade. So one example of that is tax loss harvesting. If you have a taxable account and you have assets that are now down in value from where you bought it, You can do something called tax loss harvesting, where you sell the assets, rebuy into another similar type of fund. And then what that's doing is it's locking in the paper loss. You're never out of the market, but it does allow you to get a form at the end of the year that says, hey, I can deduct up to $3,000 a year on my taxes, which is, pretty great. So there's little things like that, or there's donating depreciated assets, or company value. There's so many things that we can do when markets are down. We just have to have a conversation about it, and need to have some ability to help teach you those things. So the 5 essentials to successful wealth management. Number 1, have faith in the future. Pessimists are doomed. If you're, the type of person that thinks that the end of the world is going to come, then best to buy bullets in a garden, because that's just not a way to really look at the forward in your investing in the future, because we do believe that things will get better over time, and there are times where there's cycles where the market goes back, and that's just natural. We need to just way through those cycles. So some reasons to stay positive. I mentioned some of these before. We fully expect the coronavirus recession with a lot of job losses. So we believe there can be a recovery that's a little bit better and a little bit faster, a little bit more precise and targeted, because number 1, the Fed has been amazing about injecting liquidity into the economy and helping to keep our dollar strong during this. So they reduced interest rates down as low as they could pretty much go, and they're really helping to prop the economy up as best they can. And then as well as that, there's the fiscal piece as well. From Congress, they came out with the CARES Act. They're talking about, they have supplemented unemployment benefits as well to help people that are out of work weather that storm, so we're not having, like in 2008 and 2009, foreclosures and issues like that. And a lot of banks have actually stepped up and been readjusting their funding to be able to handle those mortgages a little bit better too. So that's where Dodd-Frank really came in a lot to help the financial system work a little bit better. And the other piece is energy cost declines. We have this oil war that's going on a little bit that helped drop the energy costs, and that's not a bad thing to have energy costs low while we're trying to stimulate the economy. So another thing to think about is there's observations of China's recovery. Obviously China being the first country that this hit for where it originated in, it's showing a meaningful improvement in discretionary spending, cargo shipments, and retail store openings. Some data from China we can't really rely or trust on, and some we can. So we feel like the stuff that is coming out that is reliable is promising, that it seems like there's some sort of normalcy that's starting to happen now, 3-4 months later. The other piece is, do not underestimate our scientific ability to find medical solutions to this and future pandemics. There's a lot of very smart people working on how do we get vaccines in place? How do we fast track this? How do we mitigate the impact to people, whether it's through use of ventilators, whether it's through medical treatments that will reduce inflammations, who knows? But there's a great quote by J.P. Morgan, John Pierpont Morgan, that says, to bet against America is to go broke. So if we look at this, we're always looking at stocks to be our inflation hedge, because one of the greatest things that we have to look out for is the loss of purchasing power. We want for you to still be able to buy the same amount of stuff over time, so we're looking at inflation. January 1st, 1960, S&P was at 58, and then later on, December 31st, 2019, it's all the way to 32.30. It's up by 56 times, where the CPI, which is the inflation, is up that same time frame by 9. So it more than made up for inflation by holding stocks in the S&P 500 in the market. So that's always an important part of a strategy, is to have some stock exposure. So we do have some people say, well, that's great. I only have a 10-year time horizon. I don't have a 40-year time horizon. And to that, I'd say, well, the good thing is when we look historically, and we're talking about a portfolio that is 100% in the market, which if someone has 10 years and left, or we're just aiming for 10 years, we wouldn't be 100% in the market. We'd have some bonds and fixed income in there to help mitigate the ups and downs. But if we were 100% in the market in the S&P 500 for any 10-year period, providing a 3% or greater return, it provided that 90% of the time over the last 90 years, which is very impressive. So there's been very few times where we didn't get a positive return. When we look at each breakdown here, it gives you a breakdown from 1940 to 2019. We see this 10 years, the left column, 10 year from 2010 to 2019. Well, that was a very good year for the market. So in most situations, we only had 1 year of a negative return, which would have been 2018. For every portfolio mix, except for an 80% bond, 20% stock portfolio, which still would have been positive then. If we go back to 20 years, to 2000 to 2019, there were 5 years of negative returns, basically every 4 years on average during that time. But again, if we look down to that 80-20 portfolio, 0. So there's a sweet spot of a certain amount of assets in stocks and certain amount of assets in bonds that can definitely help mitigate those negative years, no matter how many we're talking about, whether it's 10 years, 20 years, 40 years. Another reason to stay positive is, unlike the Great Depression and Great Recession, where individuals had a lot of debt and leverage on stocks or real estate, like the housing crisis, Dave Ramsey would be very proud because today's household debt is the lowest in recorded history. So people having money on hand, that's why we always talk about having an emergency fund. That's why I talk to business owners about having an emergency fund, not only for you personally, but in the business. Make sure your operating expenses can be covered. It's very important. So that with noting the banks are very well capitalized due to the requirements of the 2008 recession, suggests that the nation is in an even better place to recover from this pandemic. So basically, because of the Dodd-Frank Act, it has positioned banks, or required banks to have more cash on hand, more reserves. So we are in a better spot overall to be able to weather this. So essential number 2 is you must be patient. Historically, the stock market has always risen over the long run, but can decline substantially in the short run. So Warren Buffett has a really good quote where he says, "The market is the most efficient mechanism anywhere in the world for transferring wealth from impatient people to patient people." He also has a saying that says, you're supposed to be greedy when other people are fearful, and fearful when others are greedy. And I'd say right now, more people are fearful than greedy. So that's where it's definitely a good time to buy and be in the market and kind of doubling down. Essential number 3 is broadly diversify across and within asset classes, stocks, bonds, tangibles. So you might not make a killing, but it will also help you from being killed during these times. So what do we mean when we look at that? Inflation, so we just looked at a 20-year period here from 2000 to the end of 2019. Inflation was 2.14%. Stocks during that time frame, because we did hit 2 major declines in the market, and the .com and the housing bubble, it only averaged 6% during that time frame, 6.05. If you had a more of a conservative balanced portfolio of 60% in the market, 40% in bonds, you would have actually gained a little bit more return during that time frame, because you would have weathered those downs a little bit better, be 6.18%. And if you even further diversify, so you take those that stocks and don't just be just in the S&P 500, but diversify that further into some small cap stocks, some potentially some foreign stocks, emerging markets, potentially REITs, commodities, things like that, you can get a more diversified approach. So the S&P 500 worst 3 months, We're 08, 29% down during those times. Worst 12 months was 43%, but a hypothetical diversified portfolio would only have been down 20% during that the worst 3 months, or 29% during the worst 12. So basically cutting out about a third of the risk from the portfolio. And what does cutting out the risk do? Well, if we look at these different years, we'd say, well, if you were in a diversified portfolio in 2000 to 2002, you were pretty happy. You weren't down 40% like the market was. You were down 18%, but you did lose money. So that's the downside there. In 2003 to 2007, you would have been up 73% over those 4 years, but the S&P was up by 82%, almost 83. So you didn't make as much money during that time. 2008, again, maybe happy, only down 24%, not 37, but you did lose money. So it's never fun to see negative numbers on statements. And then you really wondered why you're in that portfolio in 2009 to 2019, because you didn't make as much. You were up 191%, the market's up 351%. But the interesting thing is when we look at all of that, the total return on the market would have been 211% up, where the diversified portfolio was up 213%. So you actually grow the money more in those years in a diversified portfolio, even with that massive bull run on the market in 09 to 2019. So it might not feel like it's working when it's working, but that's the power of diversification over time. So essential number 4 is use discipline, rebalance the portfolio once a year, at least once a year. What we're doing in those situations, portfolio managers in a mutual fund or in a single stock portfolio, they're going to buy the ones that they think have peaked, that maybe they don't think there's a lot more to go and that are still up, and they're going to buy into the ones that are down. They think they might just be having a down year, but there's more potential there for growth. So that same principle comes to portfolios that are all in mutual funds. You might have one that's up a lot from that year that had a good return in the S&P 500, but it makes sense to take some of those earnings and reinvest them and rebalance them on some of the ones that didn't do as well, maybe in a small company mutual fund, because the small companies might be poised to come back a little bit stronger once the economy opens up. And that's the principle of rebalancing. Essential number 5 is be very tax and cost conscious in designing the portfolio. So in retirement accounts, there aren't as many tax things to think about other than maybe Roth versus pre-tax, but especially in taxable accounts, in trust accounts, especially in irrevocable trust accounts, we really want to be careful with the tax thoughts and the cost behind it, because all those gains can be taxable. So we want to make sure we're efficient. You want to be in things that have less cost, less taxes, maybe things that have deferred taxes until you sell out of it. So just a few things for thought. Maybe never again take for granted all these things, Friday nights with friends, birthday celebration, or the stadium, mornings at the gym, coffee with a friend, crowded concerts, happy hours, and life itself. The coronavirus has really done a number on this country, but I think it's shown some positive things where people have started to say, hey, I'm so glad I got to spend this extra time with my family. Kids are being able to spend time with parents and their siblings, and we're able to spend more time at the dinner table, which is never a bad thing. So I want to thank you all for your time. If you have any questions, please feel free to reach out, give me a call, or send me an email anytime. Hope you have a great rest of your day. Take care.